The United States sits at the top with $38 trillion of debt, the European Union follows with around $14 trillion, and Japan is holding on under the weight of $9 trillion. Even oil-rich Saudi Arabia and export powerhouse China carry significant debt. With global debt approaching $315 trillion, every corner of the world is drowning in obligations. So the real question is, if everyone is in debt, who is lending all this money? Isn't debt supposed to be a bad thing? How can a system survive when the entire planet owes more than it can ever repay? Debt is not the burden we imagine. It is the backbone of the modern world. Wars, economic crises, rises and collapses all stand on the invisible scaffolding of debt. And if you follow its trail long enough, you stumble upon an unsettling truth. The world is not indebted to one person, but to itself. But that does not mean everyone benefits equally. To understand how the global debt pile exceeded $315 trillion, we need to go back to where it all began. Long before the credit card payments we make today, the concept of national debt was born not on Wall Street, but on a battlefield. The year was 1694. England was at war with France, and its gold reserves were running dry. When the king found himself cornered, he turned to merchants. They offered him a deal. They would fill the royal treasury with a system that paid continuous interest, backed by future tax revenues. The Bank of England was founded to manage this mechanism. That moment became a turning point in history. The state could now spend money it did not have. Lenders, in return, received tradable promises from the government. This was the birth of the government bond, the seed of modern finance. France copied it. The Dutch refined it. The United States adopted it to fund both independence and westward expansion. National debt became not a weakness, but a badge of credibility. A nation that could borrow was a nation that could govern. Once upon a time, empires sought gold and conquered land. Now they issue bonds and collect interest. 3 centuries passed, and debt became the primary export of the global economy. The United States owes $38 trillion, Japan owes $9 trillion, and global debt increases by $1 trillion every 100 days. Every nation owes money, every bank lends money, and every citizen is both a debtor and a creditor. So the question rises again. Who holds the other end of the rope? Let's start with the United States, because its debt affects not only the country itself, but the entire world. About half of the $38 trillion is held domestically. 2/3 of that belongs to American banks, pension funds, insurance companies, and the Federal Reserve. The remaining third, roughly $9 trillion, is held by foreign investors. Japan leads with $1 trillion, followed by China, then the United Kingdom, Luxembourg, Belgium, and others. So the phrase "America owes China" is true, but it represents only around 2% of the total. The majority of America's debt is owed to America. The Treasury issues bonds, banks and funds buy them, the Federal Reserve purchases them when needed and creates new dollars in the process. Americans pay the interest through taxes. It is a self-reinforcing cycle, and this system is not unique to the United States. This is a loop where everyone puts money into everyone else's pocket. Japan buys U.S. debt. The U.S. channels capital to Europe through the IMF. Europe provides funds to developing nations through the World Bank. Money constantly changes hands, but never truly leaves the system. Developing countries, in turn, reinvest much of the capital they receive back into Western bonds because they trust them more than anything else. In the end, the money returns to developed economies. It is a global game of hot potato where every player holds someone else's IOU. One person's liability becomes another's guarantee. The only rule that keeps the game alive is that no one walks away from the table. There is also a fourth force controlling this cycle: the market. Behind government bonds stand hedge funds, pension funds, central banks managing trillions, and massive financial institutions. They decide which country can borrow cheaply. When confidence disappears, currencies collapse, governments fall, and economies can break down. Democracy determines who governs. The markets determine who survives. And at the center of this system stands the high priest of finance, the central bank. Central banks do not just regulate debt, they manufacture it. When the Federal Reserve or the European Central Bank buys a bond, it creates new money in the process. One party's liability becomes another's asset. Every dollar in circulation is the digital shadow of a debt. There is no money without debt. For decades, this system worked only because of confidence. Investors believed governments would pay the interest, even if they never repaid the principal. But what happens if that confidence breaks? We already saw an example. In 2010, when Greece could no longer roll over its debt, investors panicked. Yields spiked. The IMF and the European Central Bank stepped in, but only in exchange for severe austerity. Argentina's repeated defaults turned debt into a national curse. Sri Lanka's fuel and food crisis erupted when its reserves ran dry. When the system collapses, the invisible creditors suddenly become very visible. The IMF, rating agencies, giant funds. But here is what is interesting. Even after collapses, the cycle restarts. Old debts are replaced with new ones, restructurings are implemented, and the machine resets under a different name. Because debt is no longer designed to be paid off, it is designed to roll over. Governments today never intend to repay their debt. This is not a conspiracy, it is official policy. Unlike individuals, nations see debt as a subscription. Old bonds are paid with new ones. Economists call this refinancing. In this system, the real product is the interest. Stability has a price, and the global economy depends on this price. Like a shark that must keep swimming to breathe, the system must keep borrowing to stay alive. It does not rely on repayment, but on trust. The United States will never reduce its $38 trillion to zero. Japan has rolled its debt for decades and now owes more than 250% of its GDP. Yet no one asks them to repay the principal. Investors only want it renewed. Because government debt is the most trusted collateral in the world. A U.S. Treasury bond is not a burden. It is the foundation of global markets. Pension funds hold it, banks use it as collateral, and central banks treat it like money. If Washington ever repaid its debt entirely, the global financial system would collapse. Banks would lose their safest asset, the dollar supply would shrink, and the world would fall into deflation and breakdown. In short, paying off such a massive debt would destroy the system itself. This is why governments issue more carefully and rhythmically. Debt is the heartbeat of capitalism. Every pension payment, mortgage, and financial transaction flows through it. This is why promises to balance the budget are often illusions. The goal is not to eliminate debt, but to maintain enough trust for the system to keep functioning. Because once trust collapses, everything stops. This is the real secret of sovereign debt. The plan is not to repay it. The plan is to appear able to repay it. As long as confidence remains, the numbers can grow without limit. But that confidence is not shared equally. Saying we owe it to ourselves is only half the truth. Interest payments flow upward. They move money from workers and taxpayers toward funds, institutions, and investors. Debt is not merely a transfer between countries. It is a transfer between classes. This is why global inequality and global indebtedness rise together. The system rewards those who hold debt and punishes those who pay it. Creditors are not villains. Debtors are not victims. They are two parts of the same engine. The real question is what happens if the engine stalls? What happens if new debt can no longer cover old promises? Then the question, who is the lender, stops being abstract and becomes very personal. Because there is no single culprit at the top. Not China, not Wall Street, not the IMF. It is all of them. And it is us. Modern finance turned debt into money. Governments issue it, banks multiply it, investors trade it, and citizens cannot function without it. The line between debtor and creditor has almost disappeared. Debt once meant bondage. Today, it means balance. But if that balance breaks, if trust fractures, the illusion evaporates, and we remember that debt is a promise that will never truly be fulfilled. Debt is not just a number, it is an illusion. And illusions remain real only as long as people believe in them. Remember this: if you fail to see what is happening around you and ignore new perspectives, you leave yourself no option but to repeat the same mistakes. If you enjoyed this video, consider subscribing so you can discover new perspectives and ideas in the future.